Hey everyone, welcome back to A Smarter Way to Retire, the podcast where we help you build a confident and vibrant retirement. I'm Tony Leonardi, you're a CFP professional from Newtown, Connecticut. And happy Halloween, everyone. I was closing down my garden over the last couple of weeks, closing it down for winter, putting the beds to rest, storing the tools, turning off the water, covering up my garlic so it doesn't freeze over the winter, and saying goodbye to another growing season. I was thinking ahead to Halloween, and I realized something. Required minimum distributions are a lot like Halloween. They show up every year, whether you're ready or not. And if you're not prepared, they can be pretty scary. So today, let's talk about the tricks and treats of required minimum distributions, RMDs. We'll unmask some common myths, avoid the traps, and maybe even find some sweet opportunities hiding in the rules. Here's what's haunting retirement accounts right now. If you were born between 1951 and 1959, you need to start taking RMDs the year you turn age 73. That age went up from 72 thanks to the Secure 2.0 Act. If you were born in 1960 or later, like I was, you don't have to start until age 75. Thank you very much. But here's the scary part. The penalty for missing your required minimum distribution is 25% of the amount you should have withdrawn. Though if you catch it quickly and fix it within 2 years, the penalty drops to 10%. Still a little frightening, but less so. So let me tell you about some real retirement horror stories that I've seen. Names have been changed to protect the innocent, of course, or the guilty in some cases. Here's what I call the tale of the double distribution. I met a woman named Margaret recently. She turned 73 last year, June of 24. She delayed taking her first RMD until March of this year, March of 2025, which is perfectly legal. You don't have to take your first distribution until April 1st of the year following the year you turn 73. Did you catch that? April year of the year following the year you turn 73 for your first RMD. Perfectly legal. But here's what she didn't realize. She also has to take her second RMD by the end of the year, December 31st of this year, 2025. So in 1 year, she will take 2 distributions. Last year's 2024 distribution, which was her first, and this year's 2025, which will push her into a higher tax bracket. She'll end up paying an extra $8,000 in taxes this year. Money that could have stayed in her portfolio continued to grow. $8,000, that's a pretty big mistake. The trick? Take your first RMD by December 31st of the year you turn 73, not the following April. Split the distributions across 2 tax years. This is another example of where having a financial model could be very helpful. If you're not in danger of being bumped up into the next tax bracket, and your model will tell you that, then maybe delaying your first RMD could make sense for you. If you're in danger of bumping up, then splitting the distributions between the 2 years could make sense. As with most things in life, there's no simple answer. The answer is almost always, well, it depends. And having a financial model will help you answer all of those it depends financial questions. Don't wing it. Making an $8,000 mistake, like poor Margaret, is not a great Halloween surprise. Here's another real-life example that I'll call the ghost of the forgotten 401k. Tom, let's call him, had 3 401ks from different employers over his career. He remembered to take RMDs from 2 of the 401ks, but the third, he totally forgot about it. He forgot he even had it. That cost him a 25% penalty on that missed distribution, about $4,500. Another big mistake. Here's what makes this particularly frightening. You can't just add up all of your 401k balances and take one big distribution from your favorite account. Or can you? Well, actually, you can for IRAs, but not for 401ks. Each 401k requires its own separate RMD. Tom's mistake was thinking he could combine them all. How many listening out there knew that little rule about 401ks? Be honest. Most people missed that one, thinking, well, if I can combine for IRAs, I should be able to combine for 401ks as well. It's not true. That's a trick, not a treat. Here's another scary story: the inherited IRA nightmare. This one's new for 2025, a new nightmare. So pay close attention. Sarah, let's call her, she inherited her mom's IRA. She thought she had 10 years to empty the account with no distributions in between. Wrong. That's the old rule. Starting in 2025, if you inherit an IRA from someone who's already started taking their RMDs, you have to take annual distributions during years 1 through 9 and empty the account by year 10. The IRS gave some relief for years 2021 through 2024, but that grace period is over. If you inherited an IRA in the last few years, 2025 is when the new rule really kicks in. So let me repeat that in case you missed it. Starting in 2025, if you inherit an IRA from someone who already started RMDs, you have to take annual distributions during years 1 through 9 and empty the account by year 10. Don't miss that one. So now let's pull back the frightening mask and see how RMDs are actually calculated. It's not as mysterious as it seems. Your RMD is calculated by taking your IRA balance as of December 31st of the previous year and dividing it by your life expectancy, which is a factor from IRS published tables. The IRS essentially says, based on your age, here's how many years we think you have left on the planet. Divide your account by that number. For example, if you're 75 years old, your life expectancy factor, according to the IRS, is about 24.6 years, meaning that the IRS thinks you have 24.6 years left on the planet. If your IRA had $500,000 in it total on December 31st of the prior year, you divide that $500,000 by 24.6. Your RMD is about $20,325. But here's what's interesting. The older you get, the smaller that divisor becomes because your time on the planet is getting shorter, which means your RMD percentage goes up each year. At age 75, we're talking about maybe a 4% of your total distribution. By age 85, it's closer to 6.7%. And by the time you're 95, you're taking out over 10% of your balance annually. This is where tax planning becomes critical because remember, RMDs are taxed as ordinary income. That $20,325 that I mentioned earlier gets added to your Social Security, your pension income, your investment income, everything. And it could push you into a higher bracket or cause more of your Social Security to be taxed. So pay attention to your financial model if you have one. Maybe it makes sense to take more than the required minimum amount in certain low tax bracket years to avoid those coming high tax bracket years. Or maybe Roth conversions could help. A good financial model, again, along with a good CFP, will help you make these choices. And speaking of Roths, here's the Roth 401k treat for Halloween. Some good news that started last year, 2024. If you have a Roth 401k, you no longer have to take RMDs during your lifetime. This is huge. Before 2024, you'd have to either take taxable distributions or roll your Roth 401k into a Roth IRA to avoid those required minimum distributions. Now, your Roth IRA can just sit there growing tax-free for as long as you live. That's not a trick, that's a treat. If you're on the younger side and listening today, this is another reason to add to your Roth 401k option if you have one. I know the tough sell is getting younger people to think about retirement. I was with a mom and her 20-something daughter recently. The daughter just landed a nice new job with good benefits, including a 401k. The mom counseled the daughter to take advantage of the 401k to start saving for retirement. The daughter adamantly rejected that advice, saying that she can't even imagine being 65 someday, and that she didn't want to reduce her paycheck by putting money into something that she won't see for 40 plus years, if ever. Has anyone out there ever heard this one before? Obviously, putting even a small amount into your 401k when you're young makes great sense on paper. You have what Albert Einstein called the eighth wonder of the world. You have time and compound interest on your side. Oh, to be young again. This reminded me of that famous quote, "Youth is wasted on the young." And actually preparing for this podcast, I looked up the origin of that quote, and it seems to be attributable to George Bernard Shaw. Someone asked him what, in his opinion, is the most beautiful thing in the world. He replied, "Youth is the most beautiful thing in the world." And what a pity that it has to be wasted on children. I love that. It wasn't my cousin Vinny, as some people think. He did say the two Utes. My cousin Vinny said the two Utes. And when the judge asked him, what did you just say? Did you say Utes? He said, yeah, the two Utes. Great movie and great memorable scene. So what's the sweet strategy that we're looking for? Qualified charitable distributions, or QCDs. If you're 70 and a half or older, and notice that's younger than the RMD age of 73, you can donate up to $108,000 directly from your IRA to charity in 2025. That's up from $100,000 last year because it's now indexed for inflation. Here's why this is brilliant. The money goes directly from your IRA to the charity. It never touches your hands. It doesn't count as income. It satisfies your RMD. And you don't have to itemize deductions to benefit from it. Let me give you a real world example. I have a client, let's call him George, who has an RMD of around $50,000 this year. He and his wife typically donate about $15,000 to their church and a few other charities annually. Before we set up a QCD plan, George would take his $50,000 RMD, pay taxes on it, let's say 24% federal plus 5% state. He would donate $15,000 to charity and maybe get a deduction if he itemizes. After taxes, the $50,000 RMD cost him about $14,500 in taxes, and his $15,000 donation saved him maybe $4,350 in deductions. Now with a QCD, he does a $15,000 QCD directly to the charities. That counts towards his RMD, so he only takes $35,000 as a taxable distribution. His tax bill drops by about $5,800. Plus, his lower adjusted gross income might help with their Medicare premium calculations. The math is even better now because of the new tax law changes, the one big beautiful bill, or the OBBB as some people call it, that was passed this year, limits itemized charitable deductions to amounts that exceed 0.5% of your income. So if you make $160,000, only donations above $800 are deductible. QCDs sidestep all of that. Here's the important part, and this gets a bit technical. For a QCD to count towards your RMD, you have to do the QCD first, or at least in the same year, before taking other distributions. The IRS uses a first dollars out rule. If George took his $50,000 RMD in January and then tried to do a $15,000 QCD in December, that QCD wouldn't reduce his taxable income. His RMD already came out first. So timing matters on this one. Halloween candy doesn't last forever, and neither does the December 31st deadline for QCDs. So here are some strategies to help reduce future RMDs. Let's talk about how to shrink the monster before it grows too big. Strategy 1, Roth conversions before RMD age. If you're between 59.5 and 73, that's 14.5 years, consider converting some of your traditional IRA to a Roth IRA each year. You'll pay taxes now at today's rates, but you'll reduce your future RMDs. And remember, Roth IRAs have no RMDs during your lifetime. This is particularly smart if you retire at 65, but you don't need the money until 73. Those are often low-income years. Fill up those 22 or 24% brackets with conversions, and you might avoid a 32% bracket later on when RMDs kick in. Again, the perfect place for a financial model to help you run these calculations. If you don't have a financial model in place to help you, let me know. A good model can help save you maybe tens of thousands of dollars when used in Roth conversion calculations. Super powerful stuff. Strategy 2, draw down before age 73. Once you hit age 59.5, there's no early withdrawal penalty. If you retire early and have years before RMDs start, consider taking distributions strategically to keep your balance from growing too large. I know what you're thinking, Tony, why would I take money out if I don't need it? Because we're talking about tax bracket management. If you're in the 12% or 22% bracket now, but your RMDs will push you into the 32% bracket later, you're better off paying 12 or 22 today, even if you don't need the money. Make sense? Again, financial models really help here. Strategy 3, are you still working? Delay your 401k RMD. Here's a loophole. If you're still working at age 73 and you're not a 5% owner of the business, you can delay RMDs from your current employer's 401k until you actually retire. This only works for your current employer's 401k plan, not old 401ks or IRAs. But it's a valuable tool if you're still working. Take advantage of that. Ready for your action plan? So as we hand out the last pieces of Halloween candy tonight, here's your treat bag of action items. If you're turning 73 in 2025, you were born in 1952, your first RMD is due by April 1st of 2026. But seriously consider taking it by December 31st this year, 2025, to avoid doubling up next year, especially if that double up will bump you into a higher tax bracket next year. If you're already taking RMDs, review your withholding. Are you having enough tax withheld? Or are you having too much withheld? This is a good time to adjust for next year. If you're charitably inclined, set up QCDs before December 31st. The deadline is firm, no extensions. And remember, you can start QCDs at 70.5, even though RMDs don't begin until 73. If you inherited an IRA this year, check whether you need to take annual distributions starting in 2025. The rules have changed and the IRS isn't giving relief anymore. If you're approaching age 73, talk to your CFP professional about Roth conversion strategies now, while you still have time. Listen, just like checking your kid's Halloween candy for anything suspicious, check your RMD calculations with a professional. The penalties are too steep to be winging it. So as I put my garden to bed a few weeks ago, I was reminded that every season has its rituals. Spring planting, summer watering, fall harvest, winter rest. And in retirement, RMDs are part of your annual ritual too. They don't have to be scary. With the right planning, they can actually work in your favor, especially with strategies like QCDs that let you support causes you care about while reducing your tax bill. Book your complimentary consultation with me at leonardifamilywealthcare.com/assessment or grab a free copy of my ebook at leonardifamilywealthcare.com/ebook. Follow us on Instagram at Tony Leonardi CFP and on Facebook at Leonardi Family Wealthcare. Subscribe on Spotify, Apple Podcasts, or YouTube, and please subscribe and leave a review. It helps other people find us. Next week, we'll be talking about year-end tax planning strategies. You don't want to miss that one. Happy Halloween, everyone. Plan smart, retire happy, and don't let the RMD monster scare you tonight.
Securities and investment advisory services offered through Osaic Wealth, Inc., member FINRA SIPC. Osaic Wealth is separately owned, and other entities and/or marketing names, products, or services referenced here are independent of Osaic Wealth. The opinions expressed herein are for general information only and is not necessarily the opinions of Osaic Wealth or its representatives. Investing is subject to risk, including loss of principal invested. Past performance is not a guarantee of future results. No strategy can assure a profit nor protect against loss. It is not intended to provide specific advice or recommendations for any individual. Please consult your financial professional, attorney, or tax advisor with regard to your individual situation.